I'm Kyle with Fundamentals of Finance, and today I'll be talking about if you should or should not avoid bonds in a rising rate environment. Keep in mind, this is not financial advice, and it is in my opinion only. According to Morningstar, investors pulled out more than $75 billion from bond funds and ETFs in the first 3 months of 2022. In this video, we'll explore why that happened, what investors may be missing, and how to think about the role of bonds in your portfolio in today's environment. To start us off, let's take a look back at what's happened so far this year. We've had rapidly rising inflation expectations due to supply chain bottlenecks and shortages that have largely been driven by a combination of COVID lockdowns in China, the war in Ukraine, and the desire to spend a lot of excess stimulus money that people received during the pandemic. In order to combat inflation, central banks like the Fed often raise interest rates, which they've started already and plan to do a lot more in 2022. Rising rates are generally bad for bonds, hence why so many people have been taking their money out of them. But is that the smartest thing to do? It may not be, but we'll get to that in a few minutes. The reason rising rates are bad for bonds is because it means that for a new bond of equivalent risk, the issuer of the bond, meaning the company or government that's borrowing the money, has to pay a higher interest rate. As the buyer of the bond, of course, if you can get a higher interest rate, aka a higher return, for the same level of risk, you'd want to do it. That means that anyone holding on to an existing bond with a lower interest rate wouldn't be able to sell it, unless it is somehow offered an equivalent rate of return to the new one. But since the interest rate is fixed and usually can't change, the only way for that to happen is if the price goes down on the existing bond. For example, let's say a newly issued bond would cost you $1,000. You get $1,000 back in 1 year, and you make 5% interest, or $50. An existing bond with the same level of risk and the same maturity date might only pay 4%. So the price would have to go down to $999 to make it even. As I mentioned before, the holder of the new bond would make $50, all from interest. The holder of the pre-existing bond would only get $40 of interest since the bond only yielded 4%. But they'd also get $10 of capital gains since they'd buy it for $990 and receive $1,000 back in 1 year. So both bonds then would offer the same return of 5% or $50 in a year. They just get there in slightly different ways. I know everyone hates bond math, so I try to make this as simple as possible. But if it was hard to follow along, the main point you need to understand for the purposes of this video is that when interest rates go up, the price of bonds go down. When the price of your investments goes down, you lose money. And that's no fun, right? But here are some common things investors might be missing. The first one is simple. If rates are rising in an inflationary environment, having your money in cash isn't a great option. Sure, the dollar amount won't change, but the value will. Money is only as good as the stuff you can buy with it. So your $100 may stay $100 if you put it on your mattress. It won't go to $95, but in an inflationary environment, $100 1 year from now may not be worth as much as it is today. So don't be fooled. You are still losing value. The second thing investors are missing, and the number one thing I hope you take away from this video, is that in a bond fund or ETF, which is what the $75 billion figure I mentioned was referring to, rising rates can be a good thing. It's not magic. In the short term, our rates are rising. They may still lose money, but in the long run, a rising rate environment can actually help bond fund investors. Let me explain. A key difference between a vehicle like a fund or ETF versus buying individual bonds is that they are constantly reinvesting in new bonds. As bonds mature or become too short-term for the profile they're aiming for, they will get rid of old ones and buy new ones, which in a rising rate environment would be at a higher yield. So let's say a bond fund has a duration of 5. I can do a whole separate video about duration, but that's a bit more of an advanced topic. So for now, I'll give you the simplified version. What you need to know is that if duration is 5, then a 1% rise in interest rates will make the bonds go down by about 5%. Conversely, if interest rates went down by 1%, then the prices of the bonds should go up by about 5%. So let's say a bond fund is yielding 2%. If interest rates never change, your $1,000 investment would stay the same, but you'd get about $20 a year in interest, or $100 over 5 years. Really, if you reinvested your gains, it would be $104 gain due to compounding interest. But what if the interest rates go up by 2% in the first year, which is the worst environment that most people are expecting in 2022, by the way? The fund will go down 7% in value. 2% rate increase times your duration of 3.5. But you still get your 2% interest, so you'd actually only lose about 5%. The value of your fund will go down 7% or $70, but you'd get 2% or $20 of interest to help offset that. So you'd be left with $950 at the end of 1 year. Not good. But from then on, your bond fund would be yielding more like 4% since it was yielding 2% before, and then rates went up by 2%. So if rates don't change for the next 4 years, where would you be in the end? Well, this may surprise you, but you'd actually be better off in the rising rate scenario. Despite losing $50 in the first year instead of making $20 if rates hadn't moved, The higher yield over the next 4 years made up for the gap and then some, leaving you with a $111 gain instead of $104 if rates hadn't moved. So yes, in the short term, our rates are rising. It may not be good for bonds, but most of the return in bonds comes from the yield. And rising rates means rising yields, and thus higher returns over time. Now, one way I've seen a lot of financial advisors and investors try to minimize this risk is by finding funds with short duration. So less risk of losing money when interest rates go up. That seems to make sense, right? Well, yes, but in my experience, even many professional financial advisors don't really understand the concept of duration. All else equal, the higher the coupon or interest rate on a bond, the lower its duration will be. Which kinds of bonds pay higher interest rates? Riskier ones. So if you're getting a higher interest rate, but your bond has less duration or interest rate risk, what does that mean? You found a cheat code? No. It means you're taking on more risk somewhere else. Often this comes in the form of credit risk, or the risk that the bond issuer will default and won't be able to pay the investors back at the end. Not only can credit risk cause huge losses, but it also tends to make bonds more highly correlated with the stock market. This would often be debt issued by companies with weak balance sheets and less stable businesses. So it makes sense. When the economy is strong and their business is doing well, their stock price often does well, and also they probably won't have any trouble paying back their debt. When the economy is weak and their business is weak, their stock price might not do so well, and they would also have a harder time paying back their debt. So generally, the more credit risk you have in your bonds, the more correlated with the stock market your bond fund will be. So where does that leave us? If you're like most people and your bond funds are in your portfolio to help provide a ballast in a falling stock market, ballast, that's a pretty advanced word, like an airbag in a falling stock market, something that would do well when your stocks aren't doing well, then you probably don't want something that goes down when stocks go down. So high yield, low quality bonds often aren't a good option, even though they might have slightly less interest rate risk. Keeping your money under your couch isn't a good option either, because while you might not lose money when interest rates rise, you also won't make any money ever. And that will erode the value of your money over time, especially in an inflationary environment. So while I don't know your situation and I don't give personalized advice, for many investors, what makes the most sense is simply to keep their money in bonds, preferably conservative bonds if they're meant to act as a ballast or airbag to their portfolio in a falling stock market. Tips, which I discussed in my video about inflation's impact on the bond markets, can help provide some protection in an inflationary environment. And one way to shorten duration without taking on more credit risk is to simply move to a fund or ETF with shorter maturities. Unfortunately, you'll have to accept a lower yield. There is no such thing as a free lunch. One simple way to get an idea of how much credit risk and interest rate risk there is in any bond fund is to type the name or the ticker into Morningstar.com and look for this little box toward the upper right-hand side of the page. When the black dot is higher, it means the fund has high quality, which means low credit risk, and it's unlikely to be correlated with the stock market. When the dot is on the left, it means it has low duration or interest rate risk. If you really want to learn how to invest, check out my free investing workshop below called the 9 Habits of Successful Investors. The link is in the description. Thank you for watching, and I will see y'all in the next video.